how much do I need to save per month for retirement? It's a question I get a lot, being in personal finance, being a financial planner, a retirement planner. How much do I gotta save per month? 15%, Upto Company Match, 30%, 60%? Well, in today's video, we'll go over the math and find out how you can calculate your monthly retirement contribution to your retirement savings. To be honest, I actually didn't know how to reply to this. I kind of found an article that said how much you should be saving, and when I reassessed my practice, it's a lot more involved. I do a lot more calculations to figure out how much you need based on what you will need when you retire, inflation, interest rates, and all that. So I thought, why not break down the math on how I do it, but also give you some variance points to figure out how other retirement plans like Social Security, like what you read online, give you as well. So let's first go to that massive search engine, Google, and find out what they have as the top 5 answers for how much should I save monthly for my retirement. Oh, plugged into the wonderful Google machine. How much should I save for retirement? We get merrilledges.com's article. How much do you really need to save for retirement? Saying that retirement experts have offered various rules of thumb about how much you need to save. Somewhere near $1 million, 80 to 90% of your pre-retirement tax income times 12. All right, that's a pretty good number. But what about for me? I'm retiring in 30 plus years. Is $1 million enough? Next, we have Fidelity, and what they say is that how much should I save for retirement? They give you a article about how much you probably should save. Next is NerdWallet. They send you over to a calculator. The next is in Forbes.com, how much to save for retirement, and then Investopedia sends you over to their calculator. So a lot of these articles, how-tos, tools, they breeze over the assumptions needed to actually calculate this. What does Social Security do? What is that 15% thing that everyone talks about? And what is that 4% rule that everyone also talks about? And from there, we can kind of get an idea of the environment and why some of us have, been so lost. We'll start off with Social Security. Social Security says that you need to save 6.2%. That's the Social Security portion of your payroll tax. Goes to Social Security, you pay that for 35 years, and it's supposed to replace anywhere between 33 to 40% of your pre-retiree income. Now, that 6.2% is a little deceptive because the employer also puts in 6.2% for you for a total of, you guessed it, 12.4%. So you're putting 12.4% away for about 35 years, and that's kind of how they get that number of 33 to 40% of your pre-retiree income. Now, what if we were to find out how much we need to fund 100% of our income? Well, we would then take that 40% and make it equal to 100%, and we'd find out that the ratio now would look something like 31% of your pre-tax, pre-retiree income saved over 35 years would give you 100% of replacement income based on the Social Security calculations. And as you and I both know, Social Security, not the most sound system, right? We have all kinds of cuts coming probably. So we can't really rely on that, but that's the Social Security model. Next, let's look at that wonderful 15% of your retirement or your pre-tax salary as the number you should target. Well, they assume that you're starting to save at age 25 and that you are pushing all the way to 67 and that you are utilizing Social Security as well. So we have Social Security propping up about 33 to 40% of our income, and now 15% saved will prop up the other 60%, but this one's saved over 42 years and also is highly dependent on whether or not Social Security is still there. So, which way is the best way? And should we target a number or should we target a percentage of income? That's the problem though. We need to target actually both. So how do we find out which one's which? The first question you need to ask yourself is, how much monthly income do you want to replace when you retire? Because the number one thing you need to do in retirement planning is replace that work income that you're missing. All that other stuff's important, like sequence of returns risk, long-term care problems, market risk, all that's important. But the number one goal of retirement planning is that income lost from no longer working. You're retired, no more work, you got Social Security maybe, and you got to figure out how to pull enough income from your assets to not have to go back to work, especially when you're 85 or so. I couldn't imagine my grandpa trying to get a job at 92. So that's the number one goal. How do we find that number? Let's take myself for example. If I want to replace 100% of my income, if I make $100,000 a year, break that down to monthly, that's $8,333 per month. Let's jump over to our annuity calculator, links down below, where we'll figure out how much lump sum I need, pretty much how much money I need right now to generate that $8,333 per month. If you watch my video on how to make your own pension, this is pretty much the same calculation, but for those of you that didn't, here are the assumptions. Well, number one, we're using an immediate annuity calculator from annuityfy.com to change our monthly income need into a one-time lump sum payment. The annuity is adjusted for inflation at 2% and has an installment refund option to guarantee at least our principal to be paid back to our beneficiaries. Now we're doing this in order to find out what we would need in today's rates anyway to replace the income of $100,000. Number two, I'm retiring at age 67. Number three, we're using the 6.675% inflation adjusted compound annual growth rate for my 30-year period because of the data on this chart here. And you can go and watch a video about why and how you can interpret this chart and the limitations of this assumption. Number four, we're estimating that number one, you want to replace all of your income with no help from Social Security. And number two, you are using Social Security at a 33% replacement rate and aiming for 80% of your pre-retiree income as your target. Therefore, you need to create a 47% replacement of your current pre-tax income. Now, some of you might be thinking, well, Matt, this is assuming today's rates. Well, today's rates are in the dumps. If you know, the interest rate is being held at zero. So the rates that they are today, while they could go lower, they could go negative. Probably we shouldn't use an annuity in that case. But for today's example, that's the assumption we're going to take. And this is a pretty good idea or pretty good rate to use because, well, the annuity rates are nowhere near the crazy 10-12% that they were in the 80s. They're at the floor, so we can use this as kind of like that floor, the bottom. Now let's see how long it would take for me, having saved absolutely nothing up until now. All right, so you go over to the handy TVM, time value of money calculator, to find out how much payments we need to do to create a future value of 2.2 million, assuming a 6.675% interest rate. That's the one adjusted for inflation based on the S&P 500 over 30 years, 30-year period of saving, annual amount. The present value going to be zero, assuming I've saved nothing, and the payment will be 25.5. So we need to look at that and compare it to the annual salary that I'm assuming of $100,000, and boom, we have a 25.5% annual savings rate that we need to accomplish our goal to replace 100% of our income when we retire. Now you might be wondering, Matt, that seems like a super little bit, but again, these numbers need to be addressed and checked every year because number one, the market could go down, it could go really up, and you really got to figure out that long-term strategy and keep in mind that the long-term strategy is something that is, of course, long-term. It's not something to be changing every time the stock market has bad news or good news. you kind of want to keep your pulse on it and adjust minorly throughout your retirement savings goal or throughout your retirement savings plan. Remember now, this amount is number one, already adjusted for inflation because the interest rate I use is the after inflation adjustment amount. And also, we can't look at the dollar value that you need to invest. So let's say you're saying, well, $10,000 is my $100,000 salary. I'll just invest $10,000 forever. If your salary goes up from 100 to 120, you need to increase that percentage to match. So if we're doing 10%, you need to increase the $120,000 salary time to $12,000 of savings. So what are some problems in this calculation? Well, the first problem is that the 6.675% can be interpreted as being unsustainable based on current market valuations. You need to be, talk to your planner, your investment advisor, or anything that to see what rate you should use based on your risk tolerance and of course your investment strategy and your time horizon. Be sure to check that chart of the historical S&P rates to give you a good gauge on the numbers you should use based on your, again, time horizon, how much time you have to invest for retirement, and your risk tolerance. While S&P 500, if you can see the chart, it moves like crazy, right? Some months we're up. This year, for example, down 32%. We're back all the way up to plus 10. So you can get a pretty heart shaking ride, especially if you have more than $1 million invested. Losing $320,000 in 1 month can be pretty heartbreaking. So you gotta keep, you know yourself, know how to invest without the emotions, use that data, and make sure the math makes sense. And hit that like button so we can continue to make the math make sense. All right, so let's go back and see what you can do for your situation. Number one, figure out how much of that retirement income you want to replace. Meaning, do you want to go for the low route and say we're going to do only 47%? We're going to save for only 47% of our pre-retiree income to be replaced when we retire? Or do we want to be more on the pessimistic side and say Social Security might not be there, so I want to replace 100% of my income? And then plug that number into that annuity FYI calculator to figure out what that magic number is. The second thing you can do is make sure that you're using the inflation adjusted immediate annuity. Number three, take that one-time premium amount, reverse engineer it so that you can figure out how much you need to save. If you already have money saved, make sure you plug it into the present value portion of the time value money calculator. And again, your present value and your future value need to have opposite signs. One has to be positive, one has to be negative. Does not matter which one it is. It just pretty much matters that you got to just make sure that they're both not the same sign. Number four, take the payment amount and divide that by the amount of your annual salary to get the percentage moving forward you need to hit that target amount. Remember, that percentage is what you need to look for, or you need to target, not the dollar amount that you come up with. The dollar amount is only used to calculate the percentage that you need moving forward. Like I said, if you make more money, you need to adjust that savings rate as well. Number five, every year run a check to see where you are, how far you are on and off target, if you need to push more money into your account. I say if you're beating the target, you should always continue to fund, because it could be that next year won't be as good, so you have to push more money in. Always talk to your financial planner, your financial advisor, anyone who you look to for this kind of advice to figure out where you should be going with your target savings rate. And again, I've made a table here based on the 40, 30, 20, 10 years away from retirement. As you can see, 40 years, you don't need to save all that much, but 10 years, you should start looking at downsizing. Retirement experts or industry experts say that you should look at downsizing, selling, figuring out ways to minimize retirement expenses if you have not saved anything and you're less than 10 years away from retirement. Were you surprised at the rates just shown based on your target to retirement? Do you have to increase your work years to push more money into your retirement plan? Let me know in the comment section down below. And of course, we'll see you in another video to figure out if the math makes sense.